morning from warm and rainy Chicago. I'm John Kosar, Chief Market Strategist and Portfolio Manager at Asbury Research. Thanks for joining me for our latest Following the Money podcast. Today is Sunday, August 9th, 2026. I want to do something a little different today. We're certainly going to talk about the stock market and show you what our models are telling us right now, but I also want to spend some time talking about how we arrive at these conclusions and why we believe the process is every bit as important as the conclusion. There's an enormous amount of information coming at investors every day. CNBC, social media, various economists, strategists, analysts, lots of politicians lately. Everybody has an opinion about where the market's going, and everybody wants to get in front of a camera, seemingly, to talk about it. The problem is, these opinions aren't investment strategies. At Asbury Research, after me doing this for 40 years, we approach this a little differently. We just follow the data. When the data changes, we change. It sounds simple, but again, after doing this for a long time, I can tell you that one of the hardest things for investors to do is change their mind after the evidence changes, or maybe they don't have a reliable means to tell when the evidence changes. And fear gets involved, greed gets involved, politics are always involved now, and tweets and mixed messaging coming out of the White House. And maybe the most important, our egos get involved. Once we buy into an idea, it's hard for us to get ourselves off of that idea because I think in our heads it makes us think we're wrong, and a lot of times we can't really deal with that. Rules help to take these things out of the equation, and that's really what I wanted this particular podcast to be about. First, let's begin with the big picture and talk about what's going on in the markets. The big picture message from our research right now is that the primary bull market remains intact, but the environment underneath the surface is considerably more complicated than the major indexes suggest that it might be. The S&P 500's enormous 6% rebound from July 30th through August the 4th has apparently ended the 10-week period of sideways investor indecision that we were going through since the middle of May and resumed the major uptrend that began back in April. But the leadership remains relatively narrow. Growth is starting to outperform value again, but small cap stocks are failing to demonstrate the kind of broad participation that we'd ideally like to see. At the same time, our global work has weakened over the past week, according to our U.S. versus the world model, which we're not going to get to today, but it's a part of our package. With the number of foreign markets that are outperforming the S&P 500 in multiple time frames falling back towards the lower end of its recent range, suggesting that U.S. stocks, particularly the growth-oriented leadership, at least over the past week or so, continue to attract a disproportionate share of global capital. Meanwhile, the economic backdrop remains challenging. Inflation is still inflated. Interest rates remain historically high. Actually, the yield of the 30-year is up at close to 20-year highs. That's a 30-year U.S. Treasury bond. And the Federal Reserve is maintaining a relatively restrictive 3.5 to 3.75 policy. Even as the latest employment data raises new questions about the strength of the economy. Geopolitical and trade uncertainty remain additional wildcards, particularly because tariffs and other supply disruptions can keep upward pressure on prices as economic growth begins to moderate. So taken together, the evidence still favors the bulls, but this is not an environment where we think investors should simply assume that a rising S&P 500 means everything is okie dokie. I certainly don't see it that way, and that's why we rely on our models and the underlying data rather than headlines, narratives, forecasts, or just simply trying to chase the tail of the S&P 500 while it's down 80 today and up 80 tomorrow. So the message that we're getting from the market right now isn't necessarily bearish, but it's also not as simple as the S&P is going up, so everything must be okay. That brings us to one of the most important tools that we use at Asbury Research. That's our Asbury 6. We let the market answer the question, what's the condition of the stock market right now? So let's go into our research center, scroll down, and get to the Asbury 6. And here it is. Uh, the Asbury 6, what is it? It's our daily data-driven gauge of the U.S. stock market's internal health. It combines 6 diverse market metrics that we selected through quantitative backtesting to answer one very important question. Should investors currently be increasing or decreasing their exposure to equities? This is updated every day on the close. 4 or more green constituent metrics equals a positive or a bullish reading for the Asbury 6. 4 or more red indicates a negative or bearish reading for the A6. Notice what I didn't say. I didn't say what does John Kosar think the market's going to do, or what does Wall Street think, or what does the latest economic forecast predict. We don't care. We're asking the market itself, and we're doing that by looking at 6 pretty diverse metrics. We're looking at the rate of change in the S&P 500. How fast is it going up or down? We're looking at the relative performance of stocks versus high yield bonds. Do people want stocks right now, which is risk on, or do people want bonds, which is typically risk off? We're looking at investor asset flows. Is there increasing conviction that the market's going to keep going higher? That's what asset flows tell us. We're looking at volatility. Is the market afraid, or does the market feel comfortable with whatever's going on inside the market? Trading volume. Trading volume shows urgency to buy. When the market's going up, we want to see volume going up. And then finally, market breadth is market participation. What percentage of the market itself is going up? Is it getting dragged up by its hair by a handful of large cap stocks, or is the market generally going higher? So as of Friday's close, the Asbury 6 is positive. As you can see, all 6 of these are green. And notice when most of them turned green, that was right around that July 27th to July 31. That was a week ago. And that's when everything got turned on its head. Everything flipped. So that told us, for whatever reason, the reasons don't matter. We still get paid the same by being in the right direction. But for some reason, there was a sea change, at least a very tactical one. And that's what forced the market higher from being on its 10-week lows. What's important here isn't just the signal itself. What's important is the discipline behind that. We don't change the model because we don't like what it's saying. We don't overwrite it because the financial media is excited about the market, and we don't change it because we're worried about an election or what the Federal Reserve is going to do, inflation, tariffs, geopolitics, or anything else that has to do with headlines. We're pushing all that aside, and we're looking at what the market thinks and following our own rules. Why does that matter to an investor? This is where I think rules-based investing becomes particularly important. Nobody knows exactly where the stock market is going next. I've been doing this 40 years, and I certainly don't know. The older I get, the longer that I do this, the more I understand. Forecasting is a euphemism for guessing. Nobody knows. It makes for good TV, but nobody really knows. And anybody that tells you that they consistently know what the market's doing is probably lying to you. Our objective isn't to predict every market turn, which is impossible, but rather to identify changes in the conditions of the market environment early enough to respond intelligently to them. That's a huge difference. The stock market has historically had an upward bias over time, so we don't believe investors need to swing for the fences on every pitch. Instead, we believe one of the keys to building wealth is staying in the game. I learned that on the trading floor for 17 years. It took a lot of punishment down there early on. And I had some older traders tell me the secret of the game is staying in the game. In other words, don't take big losses. It's more than absolute return. We're looking at maximum drawdown. We want to keep our drawdown small, especially for older investors. Volatility. We want to keep our volatility down and our beta down so we can sleep at night and we're not making emotional mistakes. And risk-adjusted returns are extremely important because they mathematically tell you how much you're risky for how much you're making. Just how good is your strategy? Having a strategy that makes you a ton of money in one particular month where it has a horrible risk-adjusted return is a recipe for disaster. A portfolio that makes money is obviously important, but a portfolio that can participate in rising markets while attempting to avoid catastrophic losses during declining markets may be a lot easier for investors to stick with over time. because the best investment strategy in the world doesn't do you much good if there's a 30 or 40% drawdown attached to it that scares you out of the market at exactly the wrong time. I know a lot of people that happened to in COVID, and I know a lot more people that happened to in the financial crisis. Another part of the process is how these models get created in the first place. At Asbury, when we identify an idea that we believe might have investment value, we backtest it. We don't simply put it into a portfolio because it worked over the past 6 months. Our metrics and models typically go through 5 to 8 years of quantitative backtesting before we even consider including them in our research or making them a part of our investment models. We're trying to answer some basic questions. Does this relationship actually persist over time, or is it just doing this right now because of the current condition of the market? How does it behave in different market environments? That same theme. How often does it trade? What are the drawdowns? How volatile are the returns? These are all really important to us. So we kind of take a defensive approach first, and then we see what the offense looks like, what the performance looks like. And most importantly, again, does it improve the investment process on a risk-adjusted basis? If it doesn't, we don't need it. There's already enough noise in the financial markets. Our job is to filter out as much of that noise as we possibly can. The next thing we're going to look at is going to go back to the research center, and we're going to look at our CEF model. Our CEF model, along with our CPM, the correction protection model, which we're not going to get to today, are our two cornerstone models. We actually have built 5 different model portfolios using these two as kind of the pillars to create different model portfolios that some of them use a little leverage, some of them have a little fixed income in them. I'm not going to get to those either today, but if you go to the website, they're there. If you go up to managed accounts up at the top, there's plenty of information in there. Let's talk about CEF. Our CEF model looks at where investor assets are actually moving in the 11 sector spiders. Here is our latest update to CEF. We're not asking which sector should outperform according to an economic forecast or because something the White House said or because of something that's happening in the war. We're looking for evidence that money is actually moving there. Here's how we built this quickly. About 7 or 8 years ago, I really noticed that sector rotation had sped up. These sector choices by the market that used to last a quarter or two were going 6 or 8 weeks. It was too hard. It was too hard to find them. By the time you could see them on a relative performance chart, that idea was half over. That trade was half over. So I built a model that measures the velocity of money moving around those 11 sector spiders, and we look at it in 3 different time frames: and a trading week, a tactical month, or a strategic quarter. And then we add, so for example, last week in the trading week, the fastest money going into the market right here, number 1, was technology. The fastest money moving out of the market last week was energy. So if we look at technology all the way across, it was first last week, it was 10th over the past month, and it was second over the past quarter. By the way, this is a poster boy for what's been going on in the sector space. Managers primarily use these to be in the right place at the right time. Unlike us, a portfolio manager can't go to cash and sit there for 3 months and wait for the sun to come out. They need to invest their clients' money. This just shows the big swing from being really bullish to the trading week, really bearish to the trading month, and really bullish to the quarter. They don't know what to do. There's a lot of mixed messages out there. And so they're swinging back and forth wildly, trying to make the most out of the most recent tweet or the most recent headline. But getting back to how they work, the lowest score means that this particular sector, which is financials this week, and financials has been up there for the past 4 or 5 months, is one of the top 3 sectors. This has a score of 9. So this is the best ranking this week. Technology is second with a ranking of 13, and industrials is third with a ranking of 14. When this changes and it's updated weekly on the weekend, we change with it. We keep following the money until the money becomes sticky. When the money becomes sticky, that's when this model really starts to do well, because it gets on board these ideas relatively early. And if you get a breakaway horse, so to speak, in this horse race of 11 sector spiders as they go around the track, that's when this model can really have some pretty impressive performance. Down here, this is where the money's coming from. It's coming from XLC, which is communication services, energy, XLE, and utilities. So that's the way this works. Right now, financials, technology, and industrials are the top three. And the most sticky one, at least over the past month or so, has been financials. Capital leaves footprints. Price trends leave footprints. Relative performance leaves footprints. And especially asset flows do. Asset flow, there is a lot of different inputs into what makes ETFs or parts of the market go up and down. In our view, one of the most influential ones is asset flows. So our job is to find those footprints, and we use SEAF to do that in the sector space. Sometimes the data tells us we're wrong. And here's something that I think is really important if you're trying to decide who to trust with investment information or with your money, which is really what you're entrusting. Our models are going to be wrong sometimes. Every investment strategy is. There's periods when the S&P outperforms us. There will be false signals. There will be times, we saw one last week, the market was set up really bearishly and then it turned on a dime. And if you weren't keeping track of these like we did in the Asbury 6, it's easy to get run over. The market changes its mind very quickly, particularly this year because of all the geopolitics that's involved. There's going to be times when a model gets defensive and the market immediately turns around. Again, just like last week. That's part of investing. It's a muddy field right now, but we all have to play on it. What matters is having a disciplined process for dealing with the market changing quickly so you don't stand there and get run over. We don't move the goalpost after the fact. If a model signal changes, we report it. If the strategy is underperforming, we show it. When the data tells us that our previous market view is no longer accurate, is no longer correct, the market changed its mind, we change our view too. I believe this is one of the biggest advantages of a quantitative rules-based process. There's no ego. There's no opinion. There's no second-guessing yourself, wondering if you missed a news forecast that told some fact that screwed up your analysis. We just follow the data. Next thing we're going to look at today is our keys to this week report. So we're going back to the research center, scrolling down a little bit to keys. Keys is from Friday. So this is very, very current. Title, Broad Market Breakout Faces Leadership Test. It's a weekly list of 10 key market factors. It could be a data series. It could be a chart that we think is most likely to influence upcoming U.S. financial market direction. We probably look at 100, 150 charts, and each week we pick 10 that we think are the most germane to what's happening right now. These 10 change from week to week, depending on what's going on in the market. So I picked out a few of these. I'm not going to go through the entire report. This is another part of our premium service, but let's look at, what do we have? 5 or 6 of them that we're going to look at this week. The first one is just the S&P 500. This is May 15th. This is the June 2nd high. Effectively, since May 15th, right here, we've been going sideways. What does that mean? In simple terms, it means the market had a nice rally here from the end of March to the beginning of June. Then it got to a point where it started, it being the market, the collective thinking of everyone who's got skin in the game, that the market went too fast, too far, or too far, too fast. And you can see we stayed inside those borders back and forth for a long time. On July the 29th, we made a bottom and the market turned hard to the upside. Our Asbury 6 caught up a day or two later, right about here. And since then, we've broken out of that rectangle. Let's call it a rectangle. What that means, generally speaking, is that this move from end of March, beginning of June has resumed after a period of consolidation where the market was absorbing its gains and trying to figure out what to do next. This chart, or this breakout, targets a move to 8,000 as long as the top of this investor indecision pattern at 76.21 holds as a support level. If it doesn't, we collapse back through it. Now the market's changed its mind again. And again, I've seen the market change its mind more over the past 9 months than I have in as long as I can remember. It's because of outside influences are inconsistent. The market can handle bad news. It can't handle not knowing. And right now the market doesn't know. The next chart we're going to talk about here is the SOX index, semiconductors. Semis typically lead when the market is going up and or if it's going down. It tends to be a leader. So here, the SOX actually broke its 50-day moving average on July the 13th, indicating that the short-term trend is now down. The long-term trend, according to the 200-day moving average here in orange, is still intact. But the bottom panel is what I'm concerned about. SOX had been outperforming the S&P 500 on a 63-day quarterly basis. That's our strategic time frame. It had been outperforming since May of last year, a long time. You could see it had a couple of tests here in March and May. Those both were bottoms in the SOX. Since July the 15th, and this is through about halfway through the day Friday, so this data is pretty current. It's been underperforming since July the 15th. That means we're not getting outperformance from the SOX. That is atypical. There's nothing that is ever absolute in the stock market, but it's atypical for us to be making new highs in the S&P 500 without getting outperformance from what I call the faster horses, and that's semiconductors, and that's also technology. Next chart is technology. This is the NDX up on top, NASDAQ 100. Again, it broke its 50-day moving average on July the 17th, came down and tested the 200-day moving on July the 29th, 200-day moving average. That's what I meant to say. And now we're back to negotiating the 50-day moving average. But look what's going on a relative performance basis. It started, this red line is not marked, but this is a 21-day moving average of the relative performance line between the NASDAQ 100 and the S&P 500. So NASDAQ has been outperforming the S&P 500 on a monthly basis since July 1st. It's been underperforming on a quarterly 63-day basis since July the 13th. These typically are the two leaders in a healthy bull market. They're not leading anymore. That's problematic to me. Again, we follow the S&P 500. That's how we get paid. And our Asbury 6 tells us that that trend in the S&P has reasserted itself, but it's not getting the leadership that you would expect in a healthy bull market. Next chart's number 3. Actually, we're going to go to chart 5. This is the, this has a long name to it. This is the Schwab U.S. Dividend Equity ETF, SCHD. This tracks dividend stocks, which are a defensive choice for managers when they're unsure about the sustainability of an uptrend. Look what's happened here. Since July 16th, dividend stocks started outperforming growth stocks, which is SPY-G here in terms of the ticker. Although it's given some of that back, we are still outperforming defensive dividend stocks are still outperforming on a quarterly basis. That's not something that you normally see in a healthy bull market. The next one is, this is a really important chart. This is more connected to the basic idea of, do people want to be in stocks or bonds? So we've got all this internal weakness showing up where the normal leaders are not leading. However, stocks are still very much favored over bonds. Notice since April 8th, SPY has been outperforming TLT. TLT is the 20-year Treasury bond ETF. We tested that quarterly trend of outperformance by SPY on June 26th. That was the bottom in the S&P. Tested it again on July 29th. Another short-term bottom in the S&P. Until this changes, even though the market is showing relative weakness, as I talked about in the last 3 or 4 charts going backwards, this is immediately more important. For the market to start to weaken internally to where the S&P 500 is vulnerable, we need to see relative underperformance by stocks versus bonds. That hasn't happened yet. So that means the market's vulnerable. I wouldn't go away on a 3-month vacation and assume the market's going to be making new highs on Thanksgiving. But for the time being, this is telling us that we still need to pay attention to how we get paid. That's the S&P 500. As long as stocks keep outperforming bonds, it's not time to sell yet. This is the last one. This is a very tactical indicator. This is VXX, which is a derivative, let's call it, of the VIX. It's a futures market-based tracking of the VIX, which is the volatility index from the CBOE, the CBOE. And this has been under its 21-day moving average since April 8th, with a couple of exceptions. A short period from July 23rd to 29th, that's when the S&P was at the bottom of its 10-week sideways range, and then just for a day on June the 10th. This means that fear has remained in a trend of monthly decline. Market fear, unless and until the VXX gets above its 21-day moving average, which is 2158, we're not going anywhere on the downside. There's been no fear. That's why we couldn't break out of the bottom of the range a week or two ago. Not enough fear there. We need to get that fear quotient up here above 2158 in order to kind of pull the trigger on a correction. Until then, it's too soon. So let's kind of get back and finish it off. We're not trying to sell predictions. I like to look at charts. I like to understand relationships. But I want to emphasize that we're not predicting. I ate humble pie about 20 years ago, and I finally realized that I'm not going to be able to predict markets. And then I shifted to this more quantitative approach. We're not selling predictions. We're just adhering to a process. Look at the data, look at the methodology, look at how the models behave when the market changes. We should be looking at risks, we should be looking at drawdowns, and then decide if the approach makes sense to us, because the markets are always going to be uncertain. There's always going to be another election or another Fed meeting or another geopolitical crisis. They just keep coming at you over the decades. We can't eliminate uncertainty, but we can create rules for dealing with it. And that's what Asbury Research is really about. Before I wrap things up, I just want to mention a couple of things that have happened here at Asbury since the previous podcast. On July 29th, Jack and I made our annual mid-year outlook presentation for Fidelity Investments. You can request a PDF of the presentation if interested, by clicking on the contact tab, or the contact button, I should say, which is right there on my mouse at the top of the screen, and then typing Fidelity PDF in the text box that's going to take you to. Also, up this Tuesday, August the 11th, I'm going to have my monthly interview on the Schwab Network at around 9:15 Chicago time. There's the Schwab Network. It's schwabnetwork.com. Typically about 9:15 Chicago time is when the interview begins. And finally, that next day, on Wednesday, the 12th, Jack and I are going to make a presentation for the CMT Association entitled When Markets Get Irrational. More info is available right there at cmtassociation.org. These opportunities allow us to introduce more investors to what we've been talking about today, a practical, quantitative way to navigate financial markets without relying on predictions or the financial media hype. So that's it for today. Let's get you back here, asburyresearch.com. If there's one thing I'd like you to take away from today's podcast, it's this. You don't have to know what the market is going to do next to be a successful investor. And that's okay, because despite what you may hear, Nobody else knows either. You got to have a process. You got to have discipline. You need a way to distinguish meaningful changes in the market from everyday noise. And you need rules that tell you what to do when the conditions change. That's what we've spent more than 20 years building here at Asbury. Data over opinions, rules over emotions, risk management over predictions, and above all, follow the money. If you'd like to learn more about Asbury Research, our research subscriptions, or our managed account solutions, visit asburyresearch.com right here on your screen and use the contact tab, the contact button to get in touch with us. Our next Following the Money podcast will be 2 weeks from today on August the 23rd, and I'm dying for it to be August 23rd because I'm ready to see the Bears' couple of preseason games. They're right around the corner. Thanks again for spending part of your Sunday with me. And if you find these podcasts useful, please like the video, subscribe to the Asbury Research YouTube channel, and share it with another investor who might benefit from a more data-driven approach to investing. I'm John Kosar. Enjoy your Sunday and keep following the money.